Markets continue to move higher through the summer, with global equities up 8.1% year-to-date in local currency terms to mid-September, and 13.4% in euro terms following recent weakness in the euro, while Eurozone bonds are up 14%. Positive earnings reporting seasons in the US, Europe and Japan, and easing of global geopolitical tensions have supported equities. European bonds have benefited from low levels of inflation and further new policy measures from the ECB in response to increasing risks of deflation. In early September, the ECB announced its second major step change in policy over the last 2 years when launching an asset purchase programme for asset-backed securities, or ABS assets. This was driven by longer-term inflation expectations becoming unanchored and falling sharply through July and August, which was seen as significantly increasing the risks of deflation. Through buying ABS assets, the ECB is trying to increase the flow of credit and lower borrowing costs for small and medium-sized enterprises, SMEs, particularly in peripheral countries. Across the Eurozone, SMEs account for 60% of value add, and this rises to 70% in the case of peripheral countries. Up to 25% of peripheral SMEs describe access to lending as a pressing problem, while rates on loans for peripheral SMEs tend to be about 1.9% higher than those for SMEs in core countries. ABS assets refer to the wrapping and pooling of loan books by banks into a security which is sold to investors. This allows banks to rebuild their balance sheets and capital and leave them in a position where they can provide additional loans to clients which they otherwise would not have been able to do had the original loans remained on their balance sheet. Thus, by providing demand for and expanding the ABS market, the ECB is hoping to increase the provision and lower the cost of credit while boosting growth and lowering the risk of deflation. While economic data has been somewhat mixed through the summer, generally momentum has improved after weather-related weakness earlier this year. In the US, second quarter GDP grew 4.2% annualised, having fallen 2.1% in the first quarter, with strength in the labour market, consumption and investment leading the recovery, while leading indicators such as ISM manufacturing and services are pointing towards growth of over 3% in the second half of the year. In the UK, recent growth rates of over 3% are likely to be maintained, also supported by strong growth in retail spending and investment. European growth has disappointed, partly impacted by the hit to corporate and consumer spending plans by the Ukrainian crisis. Growth stalled in the second quarter, with Eurozone GDP flat compared to Q1. But the recent ECB announcements, a weaker euro, and the establishment of a ceasefire in Ukraine should remove the overhangs and facilitate an improvement through the remainder of the year and into 2015. In Japan, the economy has struggled to rebound from a 3% sales tax rise in April, although recent sentiment surveys and economic releases have shown some modest improvement. If the recovery remains muted and the Bank of Japan's inflation target of 2% is threatened, further fiscal and monetary stimulus packages are likely in an effort to boost growth. In China, economic data improved through the summer following a number of targeted mini stimulus packages, although releases have weakened again through August and September. The authorities have responded to this weakness by providing additional liquidity to the banking system, which should help maintain GDP growth at just over 7%. Overall, global activity indicators suggest growth should continue to modestly improve through the remainder of 2014, with global growth for the year somewhere in the region of 3%, with a further pickup expected in 2015. The UK and US are expected to raise official interest rates in the first quarter of 2015 and around the middle of next year respectively, as the growth environment improves. Given the support provided by accommodative central bank policies to markets in recent years, there are some concerns that markets could come under pressure as this policy shift occurs. In the case of equities, however, history shows that rising interest rates are not necessarily negative for markets. This table highlights equity market performance in the UK since the early 1970s, 3, 6 and 12 months after the first rate rise in a tightening cycle. Typically, in the first few months after the rate rise, markets tend to be flat as they adjust to the changed monetary environment. Thereafter, markets tend to rise and on average have been up over 10% over the next 12 months as they benefit from the better economic backdrop which contributed to the decision to raise rates in the first instance. A similar pattern of equity performance is evident in the US in rate tightening cycles. In the current cycle, with central banks providing greater guidance around rates and with indications that rate rises will be gradual and peak below prior levels, the uncertainty around the beginning of rate tightening cycles should be less than in the past, which should be supportive of equities. In the case of UK and US bond markets, however, yields should begin to move higher as we enter a phase of higher official base rates. Equities, we believe, still provide upside, supported by an improving economic and earnings backdrop and continued positive flows from investor and corporate activity. Valuations remain extremely attractive relative to other asset classes and provide scope for further increases in absolute terms, given the low valuation and interest rate backdrop by historic standards and the current point of the economic cycle. Global central bank policies remain supportive, particularly following the recent ECB actions, with potential for further stimulus from the Bank of Japan. Even with interest rates rising in the UK and US in 2015, equities can still rise, although volatility could increase compared to recent years. While UK and US bond yields are expected to rise, in the short term, German yields could remain in a range given ECB actions and the potential for further measures to come, although some upward pressure is expected through 2015. Peripheral spreads against Germany, however, should continue to narrow, supported by ECB policy measures, while the euro can continue to drift lower given divergent policy paths between central banks in Europe and the UK and US.